Interest rates are at 4.5% and everyone is freaking out. Don't invest now, wait for rates to drop. The market's gonna crash. This changes everything. But here's the thing nobody's telling you. If you're investing for 20 plus years, interest rates might be the least important thing you're obsessing over right now. If you're new to investing and the news is stressing you out, this video is for you, because we're about to look at 50 years of data that might completely change how you think about this.
Let's get one thing straight. Yes, interest rates matter. They affect everything: mortgages, car loans, how much banks pay you in savings. But here's the question nobody's asking. Do they matter for your long-term portfolio? Like, actually matter in a way that should change your behavior? I pulled the data from 1970 to 2024. We've had rates at 20%, rates at 0%, and everything in between. And what I found might surprise you. Spoiler, it surprised me.
Here's what people think. High interest rates equal bad market. Low interest rates equal good market. Simple, right? And short term, that's kind of true. When rates spike, the market usually dips. Everyone saw this in 2022 when the Fed raised rates and the S&P 500 dropped about 18%. See, rates matter. Except that's not the full story, not even close. Because if you zoom out past the panic, something completely different happens.
From 1970 to 2024, the S&P 500 has given an average annual return of about 10.5%. During that time, interest rates were at 20% in the early 1980s, near zero after 2008, and everywhere in between. But that 10.5% average, pretty consistent regardless of the rate environment. A 2023 Vanguard study analyzed returns across different rate regimes and found something fascinating. Long-term equity returns showed almost no correlation with interest rate levels. The correlation coefficient? Nearly zero.
Here's why. Companies adapt. When rates are high, they adjust. When rates are low, they adjust differently. But good companies keep making money and growing regardless. Apple didn't stop innovating because rates went up. Microsoft didn't stop growing because rates went down. The actual economy, not the financial engineering part, but the real companies making stuff people want part, that keeps chugging along. A J.P. Morgan analysis found that corporate earnings growth has averaged 6 to 7% annually across all rate environments since 1950.
But wait, you're thinking, I literally watched my portfolio drop when rates went up. Yeah, you did, because short-term rates do cause volatility. The market hates uncertainty. When the Fed announces rate changes, traders freak out, algorithms go crazy, and prices swing wildly. But here's what matters. Those are price reactions, not value destruction. The companies you own didn't suddenly become worthless. The market just had a tantrum. If this is making sense, hit subscribe. This channel is for beginners who want calm, not hype.
Now, I'm not saying rates don't matter at all. They do affect where money goes. High rates make bonds more attractive, so some money flows out of stocks. Low rates make stocks more attractive, so money flows in. That's real. But that's about asset allocation and short-term flows. It's not about whether stocks will grow over 20 years. Think of it like weather versus climate. Rate changes are weather. They affect tomorrow. Company growth is climate. It affects your retirement.
Let's make this personal. Say you're 30 years old investing for retirement at 65. That's 35 years. According to Schwab's 2024 analysis of historical market cycles, someone who invested consistently through the high-rate 1980s, the low-rate 2010s, and everything in between would have roughly similar inflation-adjusted returns. The difference? Less than 1% annually. You know what made a way bigger difference? Whether they kept investing during the scary times or panic sold and sat in cash.
So if rates don't matter much long-term, what does? 3 things. 1. Time in the market. Every year you delay investing waiting for perfect conditions costs you compounding. 2. Keeping costs low. A 1% fee hurts you way more than interest rate fluctuations. 3. Not panic selling during volatility. Fidelity found that investors who tried to time rate cycles underperformed buy-and-hold investors by an average of 4% annually. That's massive.
Now, real talk. There is one scenario where high rates matter. If you're retired or retiring soon, high rates on bonds mean you can get decent income without stock risk. That's actually awesome for retirees. But if you're in accumulation mode, building wealth, decades from retirement, obsessing over rate levels is like rearranging deck chairs on a cruise ship. The ship's still going where it's going regardless of where you put the furniture.
So here's what you actually do. Stop checking rate news daily. Seriously, it's making you anxious for no reason. Keep your investment plan unchanged unless rates force you into genuine financial trouble, like adjustable mortgage payments. Focus on the big three. Invest consistently regardless of rates. Keep expense ratios low, and don't sell during volatility. That's it. That's the whole strategy. Boring? Yes. Effective? The data says absolutely yes.
Look, I get it. When rates change, it feels like something big. The news makes it sound catastrophic or euphoric. But zoom out. In 20 years, you won't remember whether rates were at 4% or 6% in 2025. You'll remember whether you stayed consistent or got spooked and quit. The market has compounded through world wars, recessions, rate cycles, and everything else. It'll compound through this too. Drop a comment. Are you investing differently because of rates or staying the course? Let me know.